Debt. Just hearing the word makes most people cringe, right? It's usually seen as this heavy burden that brings nothing but stress and sleepless nights. But here's the thing. For the wealthy, debt isn't the enemy. In fact, it's their secret weapon. Yep, the rich know how to use debt to build fortunes, open up opportunities, and boost their financial security. It all comes down to how they play the game. In this video, we're diving into 5 brilliant ways the wealthy turn debt into dollars. And trust me, it's going to make you rethink everything you know about borrowing. The tax hack: buy, borrow, and die. Buy, borrow, and die might sound like a wild concept, but for the ultra-wealthy, it's one of the smartest tax strategies out there. This clever approach lets them sidestep paying massive taxes while living large and keeping their wealth intact. So how exactly does it work? Picture this. You've invested in a property and made a jaw-dropping $10 million in profit. You're ready to cash out, but here comes the dreaded capital gains tax. The federal government will take about $2.3 million right off the bat. And if you're in California, you can kiss another $1.3 million goodbye to state taxes. That's $3.75 million, or nearly 40% of your profits, gone in the blink of an eye. Your $10 million profit suddenly shrinks to just $6.2 million. Ouch. But the wealthy have a smarter way to avoid this kind of tax bloodbath. Instead of selling their assets, they take out loans against them. Imagine you've got a real estate portfolio worth $30 million. Rather than selling and losing a huge chunk of your profits to taxes, you borrow against it. Loans, unlike income, aren't taxed, meaning you get access to cold hard cash without Uncle Sam taking his cut. You keep your assets and still have money to fund your lifestyle. Pretty sweet, right? Now here's where the die part of the strategy kicks in, and it's all about a little trick called the step-up basis. When the wealthy pass away, their heirs inherit their assets, like real estate, at the current market value. Let's say you bought a property for $100,000 and now it's worth $400,000. Now normally, you'd owe taxes on the $300,000 profit if you sold it. But with the step-up basis, when your child inherits the property, the value resets to $400,000. If they sell it at that new value, they won't owe a dime in capital gains taxes. So instead of selling your assets off and handing over a big chunk of your profits, you borrow against them and pass them down to your heirs. The assets continue to appreciate in value, and thanks to this clever loophole, your family keeps the fortune rolling in without the tax hit. It's the ultimate win-win. The buy, borrow, and die strategy is a financial game changer. By borrowing against appreciating assets instead of selling them, the wealthy can live lavishly, keep their fortunes growing, and pass down wealth tax-free to the next generation. It's a savvy move that lets them dodge the tax man and keep more money in their pockets. Now that's what we call playing the financial game like a pro. Shorting, the high-stakes game of betting against stocks. Shorting is like the Wild West of investing, risky but potentially super rewarding if played right. It's a strategy where rich investors borrow shares of a company's stock, sell them at today's price, and then hope the stock value drops so they can buy it back at a lower price, pocketing the difference. Sounds simple enough, right? Let's break it down. Imagine an investor thinks company X's stock is about to tank. They borrow a share currently worth $100 and sell it on the market. If they're right and something like a scandal causes the stock to crash, say down to $15, they can swoop in, buy back that share for the lower price, return it to the broker, and pocket a sweet $85 profit, minus a little interest for borrowing. But shorting is definitely not without risks. Take the GameStop saga as an example. Hedge funds lost over $13 billion when the stock price skyrocketed instead of falling. That's the danger with shorting. While a stock can only drop to zero, there's technically no limit to how high it can soar, meaning potential losses could be huge. It's a high-stakes bet where one wrong move can cost way more than the original investment. The magic of mortgages and real estate. Mortgages might sound like a heavy burden, but for savvy investors, they're actually a secret weapon to grow wealth. By using a mortgage, you can buy bigger, more valuable properties that would be out of reach if you only relied on cash. And with the right strategy, these properties can turn into income-generating machines, helping you build equity and reinvest for even more profit. By taking out a loan to purchase a property, you're essentially using other people's money to grow your wealth. As renters pay off your mortgage, you're not only covering your debt, but also increasing your stake or equity in the property. And that's not all. If you invest wisely, you can enjoy a steady stream of rental income too. It's a win-win. Let's say you find a property worth $300,000. You put down a $40,000 down payment and take out a loan for the remaining $260,000. At first, it may not seem all that exciting, but because property is in a booming area, you know its value will rise. You decide to put in another $10,000 for some sprucing up, and before long, the property's value jumps up to $360,000. Now comes the exciting part. You head to the bank and refinance the property, which gives you an extra $60,000 in equity. You can choose to either cash it out or reinvest that money into another property, continuing to grow your wealth. This is how the wealthy leverage debt and real estate. They use mortgages to buy, rent, and reinvest, creating a snowball effect that turns small investments into large fortunes. It's all about playing the long game and making your money work for you. Free up cash to invest. Who says borrowing money is always a bad idea? If you snag a loan at a super low interest rate and use that cash to invest in the stock market, it could potentially rake in profits far exceeding what you pay in interest. Sounds like a win-win, right? Let's break it down with a real-life example. Say you want to buy a shiny new car for $50,000 and you can get a loan for it at just 2% interest. Instead of plunking down all that cash, you could finance the vehicle. Why? Because while you're driving around in your new ride, that $50,000 can be put to work in the stock market, where you might see an average return of around 10% per year. If you take that loan and pay it off over 5 years, you'll end up paying about $52,583.28 in total. But if you invest that same $50,000 and it grows to $80,525 over those 5 years, you're looking at a whopping profit of nearly $28,000 just by borrowing money at a low rate. This strategy allows you to enjoy your purchase while also making your money work harder for you. It's all about leveraging those low interest rates to free up cash for investment opportunities that can lead to greater financial rewards. Leverage. When it comes to building wealth, rich people have a secret weapon: leverage. Instead of selling their assets like houses or stocks, they borrow against them, allowing them to avoid certain taxes and still maintain control of their investments. And upon their death, these assets often get passed down with a tax perk that allows beneficiaries to sell them without paying capital gains tax. Smart, right? But that's not the only way the wealthy use leverage to their advantage. By borrowing against their portfolios, they can supercharge their returns. Let's look at an example. Tom and Jerry both invest $100,000 in the same portfolio, which yields a 10% return. Tom walks away with $10,000 in profit, which isn't bad at all. But Jerry, being a bit more daring, decides to borrow $35,000 to boost his investment to $135,000. Thanks to leverage, he ends up with a $13,500 profit, a 13.5% return on investment, beating Tom's return by 3.5%. Of course, leverage can be a double-edged sword. If the market takes a downturn and drops by 10%, Tom would lose $10,000, but Jerry's losses would be steeper, $13,500 due to his larger investment. So while leverage can boost returns, it also increases the risk. Even with the higher risk, leveraging is a popular strategy among sophisticated investors and hedge funds because when used wisely, it can seriously pump up long-term profits. The trick is knowing when and how to leverage without overextending yourself. Debt isn't always the villain it's cracked up to be. For savvy investors, it can actually be a powerful tool for building wealth and securing financial freedom. By understanding tax laws and harnessing the magic of compounding interest, smart investors can leverage debt to make significant gains. While conventional wisdom tells us to steer clear of debt, it's all about how you use it. When managed responsibly, debt can open doors to opportunities that lead to lasting fortunes and a lifetime of financial security. If you're intrigued by this fresh perspective on debt, smash that like button. And don't forget to subscribe and hit that bell so you can stay updated on all things finance. Got your own thoughts on using debt wisely? Share them in the comments below. We'd love to hear your insights.